Thank you, Mary, for a very kind introduction, and thanks to the Royal Economic Society for having me here. As a student, I studied the works of Frank Hahn, worked through Arrow and Hahn's book on general equilibrium analysis, but I was never properly introduced to him or never shook his hand, but I was traumatized by him once. He came to give a lecture at Nuffield College. We were packed into a very small lecture room. Everybody wanted to see the great man, and so we were stuffed in. Somehow, it was my first year of graduate work, and I'd gotten there early and was sitting in the front row, and I understood virtually nothing. And some point during his talk, he decided to change his pedagogical style and worked up to a critical point and then posed it as a question and then pointed to me and asked for the answer. Of course, I froze like a deer in the headlights, or like being called upon by a schoolmaster, and had to say, please, sir, I don't know, sir, and felt like a complete idiot. So ever since then, this has been kind of a bit of PTSD with me. I hope that wherever Frank is and he looks down, I won't come off again as a complete idiot. But, so today I want to go back and talk to something that things I've been thinking about ever since I was a graduate student, because I did my dissertation in monetary economics. But this is going to be more of a historical take than a technical take. I now teach the history of macroeconomics to graduate students, and when I teach the history, I teach it starting in the 1930s, because this is when macroeconomics got a name and when it began to have a self-identity. And I've just put up a few characters here on the slide to show you some of the key players. But the way that I think about it, or the way that I've tried to teach it, is thinking about it as a kind of coming together or an intersection of two different kinds of streams in thinking. The one stream, very highly developed, was monetary economics at the time. The other less developed stream was business cycle analysis. So the people here, we know, of course, Keynes is one of the key people in the foundations of macroeconomics, but the person who named it is Ragnar Frisch. And Frisch was a theoretical econometrician and a theorist of dynamics, and Jan Tinbergen was a practical econometrician, and they were very important, perhaps in some ways more important than Keynes in getting things going. And I've put up Wesley Clare Mitchell here, who's the person who collected business cycle data and did that kind of analysis. And I see the beginning of macroeconomics in the 1930s as bringing all those kind of things together into one discipline. But if you think about it, why the 1930s? We normally just point to say, well, it's the Great Depression. But in fact, to make this leap into thinking about economics as having micro and macro, they were created in a sense simultaneously. There had to be a kind of conceptual groundwork behind it, and that's what I want to talk about today, is how we got to the point that economists were able at all to conceive about macroeconomics as a discipline. And I want to talk about that as terms of the coevolution of central banks and of money and of the idea of monetary policy. So let's start with central banks. What is a central bank? Well, the OECD defines a central bank as a bank that provides banking services to the government and to the banking system and is responsible for delivering the government's monetary objectives. That's a pretty good definition. A lot of central banks have different kinds of duties, but it covers most of the things in the world that we think of now as being central banks. And central banks, we're often told, are old. So this is a picture of what is now the Swedish central bank, and it was founded in 1668, so it's hundreds of years old. The Bank of England is 30 years younger than that, but it also seems to be pretty old. But what I'd like to suggest is these were not central banks when they were founded. They were actually private banks, but I'm not really talking about their ownership. They didn't function in all the functions that we now think of as central banks. So central banking, as we know it, had to evolve as an institution. Now, I'm not going to talk much about the institutional aspects. I'm more interested in the conceptual things that are going on in these moves. But it's important to remember that we didn't start off with central banks being central, and that the whole idea of calling them central banks and thinking about them that way more or less belongs to the 20th century. Now, back in the day, what was wealth? Well, most people, and it's true of your students today probably, and of your ordinary people in life, when people think about wealth, they think about it as piles of money. So in Adam Smith's day, one of the things that made Adam Smith an important economist was that he challenged the idea of the mercantilists and other groups that we should think about the wealth of the nation as how much money in terms of gold and silver that the nation had. So Smith demystified money by pointing out that what really counts for wealth is, as he put it, the ability to enjoy the necessary conveniences and amusements of human life. Some people have taken that to say that money's not important, or that money is a veil in the economy, but Smith didn't believe that money was unimportant or money was a veil. He thought that it was quite important. If we go back and think about the monetary system that existed, say, in the Middle Ages, we can start tracing the evolution here. So the picture down at the bottom are English silver pennies. This was the major coin at the time through most of the Middle Ages, and going up well into more modern times. And if you think about, well, if you have coins like this, and this is how money is handled, what is monetary policy? Well, one thing monetary policy was preventing fraud. You could clip the coins, taking little bits of silver off a lot of different ones, putting them together so you could coin a new one. You could adulterate them in various ways or make them fraudulently. And the monetary policy was directed, in some sense, although no one called it that, at keeping the coins in good shape from people who would cheat and counterfeit. And they considered this important enough that even Bishop Fleetwood, a good Christian bishop, thought that there was nothing wrong with having the death penalty for people who counterfeited coins. Now, that was one aspect of monetary policy, but the other aspect of monetary policy is the king did this all the time. The monarchs would debase the currency. Well, for what purpose? This was monetary policy as fiscal policy. They needed money to spend. They didn't have enough money. One way you could do it is cut the coins and pass them off as if they were full value. So in 800, the Mercian pound, which is the original pound sterling, actually had a pound of silver. By the time we get to the gold standard coming in the early 18th century, the pound sterling was 1/3 of a pound. If you look at the modern pound sterling in terms of silver, it's lost 99.5% of its original value. Now, what is that? Well, mostly it's people deciding this is a good way to get money to spend when you can't get it through taxes or other kinds of efforts. But that makes monetary policy very simple, and we don't have much distinction between monetary policy and fiscal policy. So if we go back to kind of Smith's time rather than to the Middle Ages, money wasn't just coin. There was already an enormous amount of technological innovation by the 18th century. Now, the Chinese had invented paper money quite a long time ago, but the first paper money to show up in Europe only comes around about the same time that the Swedish central bank gets started, and also gets started in Sweden by a different bank. But this paper money was not the paper money that we have today, because it was issued by all the individual banks and was, in principle, backed by gold. You could take your paper money to the bank get gold or silver, whatever the coinage was out of it. We also had other kinds of financial innovation, like the Bank of Amsterdam would take your gold, had 100% reserves, and then all the actual transactions were done through bookkeeping entries. So we're getting much closer to kind of modern conceptions of how things could be done. And that goes back all the way to the beginning of the 17th century. And even the check, which is now going out of style, was a financial innovation at the beginning of the 18th century. So money has become more complicated. It's become related to the financial system in general, borrowing and lending in more complicated ways. Now, what Smith saw when he thought about this technological innovation and monetary system was that it is a real thing. It is an important thing, but what kind of thing is it? Well, it's a bit of infrastructure. And Smith analogized the monetary system to the road system. So roads are valuable because they allow you to move the goods to market better, makes the goods more valuable, gets the goods where they need to be. So the gold and silver money is compared to a highway. But Smith's kind of poetical, and he thinks, well, the technological innovations that we've had are like building your highways in the air. That the monetary system with paper money is like having a great wagon road through the air. Now, the advantage of having the great wagon road through the air is that you free up the land that was beneath the roads, and you can use it for other kinds of productive things. So this is, all metaphor. And there are benefits to it, and Smith is very poetical. If you've never read him, he's very worth reading, just for the way that he writes. So Smith says, the commerce and industry of the country, when they are suspended upon the Daedalian wings of paper money, so Daedalus makes the wings and Icarus flies through the sky. I think if we can bring the metaphor down to earth, we can think about it about modern highways. Modern highways are much more efficient than the old wagon roads. We get the goods to market more efficiently. They have a lot of value in the economy. But Smith was also aware of the risks. And just like in the story of Daedalus and Icarus, when Icarus flies too close to the sun and crashes, well, our modern highways sometimes lead to spectacular disasters of a type that never could happen on old wagon roads. And Smith was completely aware that this kind of thing happened in the banking systems. He had observed himself in Scotland the collapse of the Ayr Bank through a classic bank run. People just all brought back their paper money and said, we want our gold, and the bank didn't have the gold, collapsed, and it was an enormous scandal. But importantly, Smith saw this just as you might see a crash on the highway as a kind of local accident. And the real danger here was localized. He didn't have the idea that the monetary question was really a systemic question, or that it had to be addressed that way. And so when Smith thought about monetary policy, he thought about it in terms of what has later become called the real bills doctrine. There's some argument whether Smith really had the real bills doctrine the way that later people did, but these main points are very clear in the Wealth of Nations, that if the banking system, the policy that you had to worry about was keeping the individual banks from failing. And to do that, said, well, basically you should only issue your paper money against short-term trade bills from merchants with good credit, so you know you're going to be paid back. The banks have to hold reserves enough that the exchanges they make with paper money can always be made, and can always be made one for one at an undiscounted rate. So if I bring you a paper pound, I get a pound in gold back. And he thought that if we could adopt this kind of monetary policy, then the outstanding banknotes in the economy would be returned to the bank whenever they were in excess of the needs of trade. And he thought that the banknotes, if you thought about the analysis, that they wasn't expanding the money supply in any important sense. It was actually just displacing the gold with something whose maintenance was a little bit easier to handle, and that displacement was going to be valuable because then the banks could take the gold and invest it abroad, where you couldn't use the English paper money, but they would take the gold no matter what was stamped on it, and get more profits that way, so it would add to the profitability of the banking system. And by the middle of the 18th century, when Smith is writing, the Bank of England has been created. It's a private bank. It was a private bank legally until 1946, okay? But Smith has already noticed that the Bank of England's character has changed, that it is now an important institution in the country. It has a monopoly on banknotes within London and has relationships with banks all over the country. And his claim is that it is now a great engine of state, as stable as the British government is stable. His near contemporary, Henry Thornton, also made the point, since central bank independence is an important thing today, that the Bank of England was an independent institution. He was convinced that the government was not in control of the Bank of England. But its independence was actually, even in Thornton's time, had already in some sense been importantly challenged. In 1797, the people widespread through the south of England became convinced that Napoleon was going to invade, and there was a run on the Bank of England. It looked like it was going to totally exhaust its gold supply, and Parliament stepped in. And Parliament stepped in and said, well, we'll stop the run on the bank by simply saying that Bank of England notes will no longer be convertible into gold. And for the next 25 years or so, England was on a fiat money standard for the first time ever. Now, a lot of interesting monetary economics gets done at this time. People like David Ricardo and Henry Thornton began writing about how monetary systems work, and one of their targets was to figure out how they could get back onto the gold standard without having losses for people who had held the Bank of England notes. So they wanted to get back onto gold at the old parities. But they were also interested in the question of, well, if you don't do that, if you haven't got back onto gold, how is it that we should organize and manage the paper money? So we're now beginning to see monetary policy being something of a more active kind than the kind that it had been going back into the Middle Ages. Now, there was a worry that they had. Why were they interested in that second question? Well, the worry was that they knew that there were problems. They knew that there were potential disasters from the paper money. So on the screen there, you see a picture of John Law. John Law was a Scottish economist and banker who made his career in France and convinced the French king that he could adopt a system of paper money, that it would be very advantageous to the French economy. And probably if Law had run the thing entirely himself, it would have been under better control. But the risk was that, and the king fell right into the trap of, oh, well, if I can expand the money supply at will, then I can spend for a lot of real things that I couldn't have afforded if I had had to raise the taxes and had the resistance of people. And this led to one of the first asset bubbles. There's a book that everybody, a classic, a book that everybody quotes but nobody reads, is Charles Mackay on Extraordinary Popular Delusions and the Madness of Crowds. And the first chapter of that book is about the Mississippi bubble in France. The Mississippi Company was a trading company that was supposed to trade to Louisiana, which was then a French possession. The inflation from this was enormous. The bubble popped. Law was discredited. And the people in the time of the suspension of 1797 and after were, of course, well aware of the history of law. That was one reason they deeply wanted to get back onto the gold standard and get away from this dangerous fiat money. So in 1821, they were able to do it. They were able to go back onto gold, and for the next, but paper money is still there. And for the next 25 years or so, there's very interesting debates about, among monetary economists who at that time were mainly bankers and businessmen. They were not academics of any sort. And they debated just what sort of monetary economic system they ought to have. And that's how they thought about it. They thought, we're trying to design a system that's going to be self-regulating, and some of the way that Smith thought that the real bills doctrine would let you be self-regulating. And there were groups of these people. On the Smithian side, the people were called anti-bullionists, or the banking school. On the other side, people like Thornton, who were really worried about the expansion of paper money and wanted to control it, were the bullionists and the currency school. Now, these debates went on, but eventually Parliament again steps in, and the Peel Act in 1844 again put some rules on the Bank of England. And one thing that they do is divide it into two departments, and the issues department operates on the Thornton principles. Expansion of paper money is dangerous, and so the rule got put in that basically you could only expand the paper stock in a proportion to the gold stock. If gold rose, if their gold reserves rose, they could add more paper money. Otherwise not, they'd have to retire it if the gold stocks fell. The banking department, remember, Bank of England's still a private bank. The banking department operates more on Smithian principles and is really a commercial bank trying to make profits by its lending. Now, they thought this was going to be a self-regulating system, but over that next 25 years or so, they kept having banking crises. The banking department would get in trouble, and then they would have to suspend the rules for the issues department in order for them to issue enough paper money to bail out banks that got into trouble. So it wasn't working as well as one might have expected, or as they had hoped. And this is about the time that Walter Bagehot comes along. Walter Bagehot is an economic journalist. He was the editor of The Economist. And he writes this book, Lombard Street, which is trying to describe the British financial system. And one of the points that he makes is this is no longer the British financial system. The British Empire has now become big and important, and the world looks to London as the center of its capital. And his claim is that Britain at this point, the Bank of England in particular, now hold the gold reserve stocks for the entire world. So he's beginning to look at the banking system systemically, no longer locally like Smith was looking at it. And it's not his ideal system. What Bagehot wants, what Bagehot would think would be ideal, was for the reserves to be widely distributed among banks within the UK, but also among banks across the world. That was going, in his view, to be a more stable system than the system that they had. And he was very worried that having all the gold concentrated in the Bank of England was going to make it, financial crises more possible and perhaps worse. But he was a pragmatist in the sense that he didn't think he could get his ideal system, and so what he thought about was, well, how do we manage the system that we happen to have? Money will not manage itself, and there's a great deal of money in London to be managed. So most people today, whenever we have a financial crisis, remember that Bagehot had a rule about how to deal with financial crises. And the rule was, in a crisis, when there is a run, when there is a possible systemic collapse, the bank needs to advance its reserves freely, to make sure that the reserves are made available to the people who need them to protect themselves against the crisis. But they're supposed to do it at high rates of interest to dissuade people who don't really need the reserves from just borrowing them on spec. And they're only supposed to be lent to actors with good securities. That they don't want, as Smith would have put it, the projectors and the prodigals to get their hands on the money. Now, in modern times, people will quote back to you Bagehot's rule whenever we have a financial crisis, but the behavior of the central banks is mainly restricted to the first point, to advance the reserves freely. They don't typically raise the interest rates, maybe they should, and they don't always put the money out there against good security, and maybe they should do that as well. But Bagehot also had a second rule in Lombard Street about the management, and this is a rule that most people haven't paid much attention to and discussed. Not in these days, but under the gold standard perhaps more so. And this was that on a day-to-day basis, when the reserves of the banking system were being depleted, that was the time to raise interest rates to try to draw the reserves back in. And when they were building up too much, you could lower interest rates and let them back out again. Now, what's the critical interest rate here that gets that balance? Well, that's not always going to be the same, and he thought that you had to get at it improvisationally. But the point of this rule is to not get into the crisis in the first place, to manage the money well so that a crisis doesn't occur. So by the time we've gotten to Bagehot, we're seeing that people are thinking about the banking system, at least, as a system and as one with widespread implications. But Bagehot was a journalist, political writer, an economic writer, connected to banking people, and most monetary economics was done by practical people. It wasn't done by academics. It was done by people who actually had skin in the game. But maybe sometimes our profession has some advantages over practical people, as we can perhaps take a higher view. And this is where Knut Wicksell, a Swedish economist who is an academic, comes into the story. So Wicksell differs from Bagehot because Bagehot thought that the ideal system would be a system where the reserves were widely spread through the banking system. But Wicksell says, no, that's not the ideal system because it's not even a possible system, because it is the nature of banking to become more and more centralized. And the reason that it's the nature of banking to become more and more centralized is because to have the central bank is the anchor or link, and he hasn't talked about central banks actually with that terminology yet, but the central bank is the anchor or link to a network that has to be pinned down somehow, and that even if we left it entirely to laissez-faire, the banks would keep concentrating until they created a central bank out of nothing, more or less, is the idea. Now, Wicksell actually accepts Bagehot's management rule. It's exactly the rule that he would advocate, but he takes a different view of how it should be stated. And it's an interesting move because I think this is the point at which macroeconomics actually comes into the world as a background concept that people in the 1930s can build on. So he restates Bagehot's rule by saying, what you watch is not the flow of reserves, which the bank could watch directly from its own accounts. What you watch is the price level. So when reserves are coming into the country and driving up prices, then you should raise the interest rates to drive them back down. And when reserves are flowing out of the country, you should raise the interest rate, okay? But it's because you're watching the price level. When they're flowing out of the country, you see the price level falling. So the whole idea here is he has the same rule as Bagehot's rule, but his indicator is no longer a parochial indicator of the banking system, but a systemic and economy-wide indicator of the price level. So now he's thinking not of managing banking, but in some important sense, managing the state of the whole economy. Now, they were on the gold standard, and Wicksell worried that the problem in the gold standard is nobody is in direct control of the gold or the silver. And it's exactly like Keynes. He's not quite as poetical as Keynes. Keynes referred to gold as a barbarous relic. And Wicksell has more or less the same point. He looks at especially the second half of the 19th century, and there are gold and silver discoveries all over the world inflating the amount of gold and silver money and driving up the price level. And this is completely out of the control of the central banks. And he wants to think about, well, what can we do about it? How can we get back some sense of which this is a matter of human agency and not a matter of just what geology does for us or what the combination of greed and geology do for us. And so he does something that economists, at least since David Hume, have been doing, is he constructs a thought experiment. And on the one side, he thinks about the gold standard. He said, well, how does the gold standard work? Well, when gold flows out of the country, the prices in your country go down, and your country becomes more competitive, and then the gold starts flowing back into the country, and when it flows into the country, it drives the prices up, and you lose prices go up, and you lose competitiveness, and then it flows back. So it's like a pendulum, and the pendulum has a kind of natural stability to it. And then what Wicksell says is, well, let's imagine that we are completely off the gold standard, that we're on a fiat money standard, that we're on a pure credit standard. There's just, the banks can expand the credit however they want. How would the economy work under that kind of thought experiment? And he says, well, unlike the pendulum, you could think about that as, instead of a bob on a pendulum swinging back and forth, you could think of it as a ball on a flat plane. And if a ball on a flat plane rolls, friction may stop it at some point, but it's not going to automatically go back to where it was. Now, you can combine that with Bagehot's idea that there is some interest rate that balances out and keeps the flow of reserves from neither going in or out of the country, and Wicksell calls that the natural rate of interest. Okay? And then, if you think about that, then when the interest rate is above the natural rate of interest, for Wicksell, the price level is falling, and there's nothing to bring it back. And when the interest rate is below the natural rate of interest, the price level is rising, and there's nothing to bring it back. So you can see in my little picture here that the ball would just keep rolling as long as that interest rate condition kept going in either direction. And for Wicksell, this is what he referred to as a cumulative process. And for the first time, the dynamic considerations get brought into thinking about how the economy works. And that is the part, the idea of the natural rate of the interest and the idea of the cumulative process and the importance of a dynamic analysis is what sets us up for what happens in the 1930s. Now, I don't really teach much when I teach about macroeconomics about Wicksell, because I typically start in 1933 when Frisch gives the name to macroeconomics. But Wicksell was clearly influential in the process of these thinking. So all in the 1930s, all the key people trying to build macroeconomics, trying to combine monetary theory with business cycle analysis, are all making reference to Wicksell. Hayek does it, Keynes does it in the treatise on money, Ragnar Frisch starts working on dynamic analysis mathematically, and he also cites Wicksell in his famous paper on propagation and impulse problems, from which, for example, people who do DSG modeling are always citing, and again, it's a classic. I doubt that most of them have ever read it, even though they will go back and cite it. Now, Keynes is a bit of an outlier here because, of course, he repudiates his own theory of treatise on money and writes the general theory, and in the general theory, he repudiates the idea of the natural rate of interest. and doesn't talk as much about dynamics as he had done in the treatise on money. But nevertheless, this thread is running through the macroeconomics of the 1930s, and is what sets the kind of conceptual background in which that economics begins to be developed. Well, that was a thought experiment that Wicksell was doing. We were still on the gold standard. We stayed on the gold standard until World War I. Many countries went off, as they do during wars, and then during the 20s and 30s, people were intermittently trying to get back on or getting off the gold standard. The war comes along, and the Bretton Woods system creates a kind of complex version of the gold standard. And this complex version is one that Wicksell actually had himself imagined, that we could have fixed exchange rates between countries, and by coordination of the central banks in the different countries, we could perform a kind of stable system with the purpose of having a stable macroeconomic environment. But, as we know, the Bretton Woods system didn't survive. 1973, we finally went off of it. And finally, in 1973, where are we? We're in, more or less, Wicksell's thought experiment. We now have pure fiat money, credit-based money, and the question is going back to exactly the issue that Bagehot had raised for the banking system is now raised for the whole economy. Money won't manage itself, the economy won't manage itself, and we have to have monetary management of some sort. This is where we finally get central banks being the kind of central banks that Wicksell imagined. And the idea of the natural rate of interest, even though it was suppressed somewhat by Keynes' general theory, has come back to us. You can think of the natural rate of unemployment that Milton Friedman gave us the language for. He explicitly says, I'm borrowing this language from Wicksell, and you can think about that as a kind of application of a natural rate idea to something more like Keynes's general theory analysis, which is done in terms of monetary aggregates rather than in terms of interest rates. But more recently, the natural rate of interest has made an explicit comeback. So Michael Woodford's book, Interest in Prices, takes its title directly from Wicksell's book. And if you look at the financial news in the Wall Street Journal or the Financial Times, or even in ordinary newspapers, I see the term natural rate of interest referred to constantly today. So we still have the kind of Wicksell ideas being very important for us. So what are the lessons here for our time? Well, the way Smith saw it, the monetary system was a real productive thing, but it was thought of as infrastructure. We needed to be careful about how it was maintained, keep it in good repair. And he thought about monetary policy as just being a matter of institutional design, not of management. Bagehot sees the banking as much more intimately connected to money than Smith had seen it. So the borrowing and lending of money is not a separate thing from the quality and the operation of money itself. And for him, for Bagehot, design is important, but again, he was the practical person who realized that all of these institutions are not really imperfectly designed and never can be. They're kind of ramshackle, but we have to figure out how to make them work, whatever kind of thing that we're given, and that requires active management. But Bagehot saw this as still a banking problem, not as an economy-wide macroeconomic problem. And Wicksell says, look, monetary policy is no longer the parochial concern of the banking system, and we need to understand how the economy as a whole works and how the money interacts with the economy as a whole. And this gives us the need for people like us, academics, who can study these things, think about them, and convey some of the things that we've learned to the people who actually have to pull the various levers. Well, we still have a specter haunting monetary economics, and that specter is the ghost of John Law. John Law referred to printing paper money as coining paper, and I don't know how important it is in the UK or in Europe, and it's not very important in academic circles in the United States, but in political circles, there's a lot of currency to this idea that now goes under the heading of modern monetary theory. And the idea of modern monetary theory is, well, money is simply a creature of the state. The state can decide what counts as money. The state can decide how much money there is. And as a result, the state does not really face a budget constraint. Okay? So one of the key things that's interesting about modern monetary theory is they talk a lot about things that don't seem to have anything to do with money, like climate, the Green New Deal, guaranteed annual income. A number of progressive policies are discussed in the books on modern monetary theory. Now, why is that? Well, this is the ghost of John Law. This is a return to the idea that there's no difference between monetary and fiscal policy, and they're looking at money as just an alternative way of raising funds for the projects that they're interested in. Well, here's where it's kind of useful to go back to Wicksell. Right at the end of his book, he says, those who expect monetary measures to perform miracles might well remind themselves of the well-known fact that the coins do not give birth to offspring, that even if they did, the precious metals and banknotes would constitute neither sustenance nor clothing. Well, there's no particular reason to think that the paper coins of 2024 are any more fecund than the gold coins of 1898. And with that, I think I'll stop.
Right. So we're looking forward to some questions. Would you like to sit, or would you prefer to stand? Yeah. Do you want to sit this side in case you want to get back up to the... Okay, so can I invite some questions from the floor? There's microphones around, so can you wave your hand so that they know where to send a microphone? Okay, maybe I can... Sorry, was I only just switched on? Do I need to repeat that? Okay. Thank you. Thank you very much, Kevin. That was a real whiz through an awful lot of history. While I'm hoping that we can get some questions from the floor, I'm just wondering about the extent to which some of these theorists and some of these commentators are sort of framing this as an internal domestic problem, when in fact, you know, as if the money is part of a country system, when in fact an awful lot of this, throughout these periods, a lot of the gold is flowing in and out because of the trade flows. So the kind of international dimension of, or the interference of an international framework is somehow not always clear in some of these monetary theorists. Do you see my point?
I see your question, but I'm not entirely sure that that's the way to frame it, because they were well aware of where the gold came from. And England doesn't have gold mines. No. They knew the gold came from Spain, that it was being traded widely. They were well aware of the trading relationships and gold going back and forth, and of the financial system having developed certain kinds of financial instruments to make it so you didn't actually have to ship the gold, you know, so bills of trade and things like that. So Smith is very much aware of that. David Hume has his whole idea of the specie flow mechanism is exactly on that. So it's not the fact that it's nationalistic. I think it's more that it's parochial, that it's not, it's for them, it's about trade, and it's about the banking system, and it doesn't seem beyond some institutional structure
to require management, that there's a sense in which, especially Hume, who's, don't mention in the talk, but he's the most modern of all these economists in the fact that he thinks in fairly abstract accounts of things, where Smith thinks about the actual institutional details and things. And this system looks self-regulating. And it takes, the real development is a development towards the idea that it's not self-regulating, that it requires management, and that the management has to be cognizant of more than the banking relationships.
Yeah, so yeah. Questions, please. She's having a hard time seeing. So yes, can we have a mic over the back here, please? And perhaps you can say who you are, so when you introduce your question, please.
Hi. Yeah, I'm Andrea Zaghini, and I work in a central bank, so I do have some skin in the game here. Yeah. No, but this is sort of a provocative question, because, I mean, I liked a lot your excursus, but at the end, in my opinion, a piece is missing. Suppose we are in a perfect world where our politicians are know what the country needs and everything. So what would be wrong with this idea of fiscal dominance, that the central bank should work for the government, for the state? If everything is perfectly set, the banking system just does its job, let credit and supply, the demand for credit and the supply of credit just meet, does its job. I mean, from a theoretical point of view, this doesn't seem so wrong, does it?
Okay. Well, I think this is the kind of thing that economists are likely to come up with, because like David Hume, we tend to think in terms of fairly abstract and you know, simple accounts, simple models, and in that simple model, presumably, it works fine to basically tax through the monetary system, but provided you keep it under some kind of control and regulation. And the problem that I think that, say, Wicksell was thinking about was, it's something like the sorcerer's apprentice. It's okay if you're the sorcerer and you're in control of your magic. If you're the apprentice and you get out of hand, you know, I presume that your suggestion is not that fiscal dominance is okay if every possible desire that of some political group has to spend the money is just given into immediately without any other further thought about the real effects. And so that's the danger. And that was the thing with John Law as well. John Law was actually a competent economist for his day, and probably, Mackay, who wrote the book on the extraordinary popular delusions and the madness of crowds, and Adam Smith and Thornton all say, you know, if John Law had actually been running things, it would have been kept under control. So fiscal dominance may be fine if you're running it, but or would you think every political party you can imagine could run it? I mean, that's the...
Yes, there's a question here, please. Sorry, can you see? In the fourth row back, can you put your hand a bit higher? Just in front, the first one. No, yeah. Yeah, next to you. No, in front, thank you.
Hi, Pam Wright, former central bank economist and now civil service economist. You mentioned the value of having academics involved in monetary policy. Do you think that having academic members of the Monetary Policy Committee for the Bank of England is valuable, or do you think they revert to groupthink with the Bank of England members of the Monetary Policy Committee?
That's a very, very interesting but sociological question. I think what academics do are the kind of things that should be informative. And it's interesting in the history of central banking, it's only been relatively recently that, that highly educated economists have been involved. The bankers were initially resistant because they thought that they knew all about banking, and precisely because that was a parochial interest, and the academics bring something non-parochial to it. But there's a risk there. I had a colleague when I was at UC Davis, Tom Mayer, who was a well-known monetarist economist, actually looked at the minutes of the FOMC meetings and said, you know, it's just embarrassing to hear the economists talk in these meetings because they wouldn't have passed their own first-year undergraduate exams for some of the things that they say. So there are risks. I mean, there's always risk. But I do think economists bring something to the table, and you know, that they are a voice to be heard, not necessarily the people who get to run everything, but they certainly should be heard. And I think we're valuable as a profession.
Thank you.
Much of the public doesn't agree.
Just behind you, and then after that, back along that road to the lady with the long hair who had her hand up before. Sorry, yeah.
Thank you very much for the crash course. So my name is Ahmed Pirzada, so I'm a senior lecturer from the University of Bristol. So I've got a bit of coming more from the popular discourse. So some of the discussion around the opium wars is also linked with, let's say, China or the Chinese government at the time hoarding a lot of gold because of the way they were trading. Does that show up anywhere in the discussions here? Because I suppose that's also kind of tied to the banking system or the monetary development that were going on here. If that's true, what do you think about that? Thank you.
I don't want to pretend to know too much about this. As I understood it, Asia was a sink for silver more than gold, but it was a sink for precious metals, and that there was, that much of it was hoarded in the way that people had imagined money to be in a kind of pre-Smithian age. The best place to have your wealth is in metals. And that's more or less, I mean, it doesn't come up directly in the people that I've been talking about, but that's very much in the same spirit as the worries that Wicksell had about new gold discoveries and things. There was part of our monetary system that was given over to forces that were entirely beyond management. And this is part of what, persuaded Wicksell that we ought to think much more in terms of getting rid of the gold-silver base for the monetary system, because that could make it more controllable. And I don't know, Keynes' very first book is on the Indian finance, monetary system of India, which at the same time that Britain was on the gold standard, India was on a silver standard. And it was exactly these kind of problems that he was addressing. I have not thought about exactly how that intersects with the story that I have told about Wicksell, but.
Thank you. Other questions? Yes, please, at the front.
Thank you. Hello, my name is Nectarios Aslanidis, and I'm from the University Rovira Virgili, Spain. Thank you very much, Kevin, for this very interesting presentation. I was thinking about the 80s and the 90s. We saw a very, in my view at least, a very successful monetary policy with inflation targeting and strict rules, Taylor rules, for example. And this reminds me a bit of the gold standard period with low inflation and good growth, say. But after the global financial crisis, and especially after the outbreak of the COVID pandemic, we saw a totally different monetary policy, and I would like your view on whether we should go back to a strict monetary policy as we had in the 70s, 80s, or in previous eras. in history. Thank you.
Well, it's a matter of, as a matter of sort of personal opinion here. I don't think this is an analytical answer. It actually goes back to the first question about fiscal dominance. I think the reason the monetary system has behaved in the way that it has in the post-crisis and COVID time is not because that is the desire of monetary policymakers, but because we've had fiscal responses that they're worried about. So I would think that it's less a need to reform the conduct of monetary policy and more a need, at least in the United States, and I think this may be true in other countries, but I haven't followed it as much, but in the United States where I am, I think the fiscal house has to be put in better order. And then I would probably trust the central bankers. I don't think they have any desire to have high inflation, for instance.
More questions? I think there was one. Yes, here, please.
Thank you very much, Kevin. I'm John Turner, Queen's University of Belfast. Really enjoyed your talk this morning. I have two very straightforward questions, but they're complex, possibly in the answer. So based on your analysis, what is a central bank? Okay, and second question, what then gives fiat money value?
Okay. Well, I'm perfectly happy to accept the OED's definition of a central bank. I think if you think what definition captures those organizations in the world that we think are central banks, it pretty much does. It says it's a bank that is the bank for the government and other banks, and it is a bank that's been given significant management responsibilities over the economy. The OED suggests it's government policy, so they don't really believe, the definition doesn't believe in central bank independence, but I think we could allow that. So I don't think there's any problem today of identifying what a central bank is. And then the other is what gives money value? Well, I think one lesson to come out of this is that there's an important sense in which money is a real thing. And when we were under the gold standard, it was clear what sort of real thing it was. If I had anybody's debt and it was designated in pounds sterling, I got myself out of the debt by giving them, gold guineas, and we were done. I think that idea of what it is that gets us to the point that we're done with the debt. I wrote on this a long time ago. I referred to money as whatever is the ultimate good of conversion for a financial system. So I would say that even, central bank reserves, which we think of as sort of the paper or electronic money and not having any, material form, is exactly that thing. If I have a debt and I pay my debt off in the national currency, that's as far as I can go. Nobody else is under any obligation to me. Now, why does that currency itself have value? Well, because we all value it. So it always has that kind of bootstrappy characteristic. But that's a fragile, that kind of, we value it because we value it, is exceedingly fragile, and it needs some reinforcement. And the reinforcement comes from certain institutions that make this seem normal, and from things like taxation. So in this, I think the modern monetary theory has something true to be said, because what they say is it's the taxing authority of the government that gives money value. Well, I don't think it gives it the value. The value is the fact that there's a limited amount of it, and we all have this idea, you trust me if I give you £1, I trust you if you give me £1, that's fine. But every once in a while, we get a little uncertain about that. And not so much perhaps in this country, but if you get in a country where there's disorder, people may get uncertain about the money. Well, if you have to pay your taxes in it, then you have a good reason to believe that somebody at least is going to value it. And so there are other kinds of enforcement mechanisms like that. There's a very interesting case I read once about, how did you get money, how did you get kind of Stone Age people in New Guinea to work for wages, to work in the monetary system. And the way that they originally, the Australians did this was to go out into the jungle and leave valuable goods for them, cooking pots and things, to get them used to these are things worth having, and then to open up a store and say, well, if you want to buy things, you have to have money, you know, Australian pounds at the time, I think. And the way you get money is to work. And so they gave them a reason to value the money. And we have those reasons all around us. But they have to be protected. So in that sense, the same problem that Smith and other people had pointed out about, you know, counterfeiting or, you know, keeping the monetary system in good repair is something we still have to do. Different instruments, so we do it differently. But.
Okay, I think we'll draw this session to a close. It's been really interesting how the range of things that you've been able to cover here. I had briefly, a long time ago, spent a year working at the Bank of England and a couple of years at Citibank. And it's really sort of brought back all these problems about actually, if you're in the banking system, what does it look like and how does it work? And speaking also as a historian of economics, Knut Wicksell is now one of my heroes, because he really moved the whole project onwards. So thank you very much, Kevin, for a very rich talk with lots of interesting aspects and lots of great pictures, which I was really pleased to see. Thank you very much, Kevin, and thank you all for coming. And the next session, I think, is at 12. This clock is wrong, so you have time to find your new session in the general sessions, I think. So thank you, Kevin, very much indeed.
Well, thank you all.